Wednesday, January 29th, 2020, Maneco 64, home of alternative economics and contrarian views. This morning, I want to talk about the Fed, the repo market again, and illiquid assets, and the Woodford Fund as well. I was looking at a couple of articles yesterday, one from the FT about the Woodford Fund and how much money the investors are getting back. I was reading one in the Wall Street Journal about the Fed meeting today, about their repo operations, their not QE of buying T-bills. And I found kind of a connection reading some of the comments in the Wall Street Journal story, comments from the readers. Found a really interesting comment that I'll go through. Before that, though, I want to look at where the markets are this morning. It's 8:40 a.m. London time. Of course, today, later on at 2 p.m. New York, we have the FOMC, or the Fed decision on rates. They're not expected, of course, to do anything to interest rates, but there will be a press conference at 2:30. Jay Powell will hold a press conference, and there might be some information that pertains to the repo operations and to QE or not QE. So let's quickly look at the markets. Yesterday, of course, we saw a rebound in the stock market after big drops the previous day. We dropped about 1.5% the day before yesterday on Monday. Yesterday, we recovered. The Dow was up 2/3%, S&P 1%, NASDAQ 1.4%. I noticed that the S&P closed the gap that it left, and I noticed that this morning the Dow is kind of trying to close a gap, and I say trying because it's still a pre-market, it's still just the futures, but the S&P yesterday closed the gap. Not sure about the picture in the stock market. I would say that it's not out of the woods yet. Spot gold is at 1569, up just a couple of dollars. The range has been 1563 to 1570. It's funny because yesterday, early on, Bill Murphy always talks about, and he has for years, that the cartel or the bullion banks, the people who manipulate precious metals and the markets in general, they give signals. And the signal yesterday was pretty clear. They went after silver even though gold was fairly steady. I think it was holding around 1580, and silver was being hit really hard early on before the US opened. And I thought to myself, well, they're going to go after gold later on today. And sure enough, they did. They goosed up the stock market. So that's something they've been doing for many years, if not decades. Why do they do that? Well, because it gives the people they work with the signal. They say, well, they're going after silver. Well, let's get ready for the move on gold. So that's what happened right now. Silver is up 2 cents, just around 1750. And I have to talk a little bit about something that I did yesterday. I decided to put some funds into my IG account, not that much, and to get involved in options. They do options. You can bet on the options. So this is not really buying options, it's betting. I know it's a derivative of a derivative, but I thought silver just was overdone. So when silver was around 1755, 56, I bought a call option on silver. I'll tell you which one I bought. It was the 1850 call, 1850 strike, and it expires on March 20th. So have a bit of time. And afterwards, I went to do something, came back, and I saw that silver had broken through 1750, and I thought to myself, well, that option's gone down in value. It's probably losing now the position, But no, surprisingly, it was up, even though the market had gone down since I bought that call option. The value of it went up, which doesn't make sense normally. And the reason that happened is because volatility went up, implied volatility, or the cost of options went up. So it didn't matter if you bought a call or a put, wherever the market went, it meant that people want upside protection in silver. So that could be a good sign. Am I saying that silver has bottomed here? No, but I found it very strange. I've had this happen in the past where I buy an option, a call or a put. The market goes the other way, but the option actually does well. That's a sign that there's a bit more volatility in the market and that people kind of not fear, but they expect big moves. So just wanted to put that out there. As I said this morning, stock markets are continuing to go higher. The Dow futures is up 77 at 28,806. Before I go further, I just show you the chart here. As you can see, yesterday the Dow didn't close the gap, but today it's closing the gap here, as you can see. And there's a interesting trend line here. So it will be interesting. I think what happens today at the FOMC, at the press conference, might move the markets. We'll have to see. As I said, S&P closed the gap yesterday. So right now, S&P futures is up 9.5 at 32.86. Of course, we had some the earnings and results from Apple, which were really good. That helped the market after the close. And I noticed, though, when the futures reopened, that the market actually was down slightly, which was weird, but now it's back up. The NASDAQ 100 future is up 30 or a third of a percent, 91.21, not surprising with the Apple results. Apparently, though, their range of forecasts are quite a few now. They've given a lot of possibilities that could happen because of this virus outbreak in China. Currencies, sterling is down slightly, not much, 130.18. The euro is down almost 0.2% at 110.05, and the dollar is unchanged against the yen at 109.08, and slightly lower versus the yuan at 696. Crude oil is rebounding this morning. Looks like there's some data yesterday after the close as well, helped the market, and the stock market is going back up. So we're up 1.3% at 54.10. WTI Brent is up 1.2. Interest rates, or the bond market, the 10-year yield has risen. We got down to around 160 yesterday when I was speaking yesterday morning. Right now we're at 163. Only up 3 really, considering the market is up almost 250 since then. It's not a huge move. So yeah, illiquid assets, the repo market, the Federal Reserve, the Woodford Fund. I don't think even the people on Wall Street, even the Federal Reserve, even the BIS, even me, of course, don't really know exactly what's going on in the repo market, why it kind of clogged up, why rates spiked in September to 10%. We really don't know. There's a lot of factors involved, and I think it's very hard to say this is it. It's Deutsche Bank, it's this and that. And I have spoken about Deutsche Bank. I have said that the help the Fed has provided to the repo market is probably helping Deutsche Bank indirectly, and that's a possibility. But I think one thing that people are not talking about, and actually a guy who made a comment in one of the articles I was reading yesterday about the Fed meeting today and the repo and QE, made me think this guy could be right. Illiquid assets. So what are illiquid assets? Well, they're assets that hedge funds, some mutual funds, and as you will see by the Woodford Fund, family offices, which are basically are private hedge funds for very wealthy families, private equity firms, and don't forget Jay Powell, his career before the Fed was at the Carlyle Group, which is one of the biggest private equity firms in the world. They buy these private illiquid assets, which means it's very hard to liquidate these assets. It's not like you call your broker and you sell it on the New York Stock Exchange or the NASDAQ. These don't trade publicly. So when you put your money into a liquid private bond or private equity, it's very hard to liquidate it when you need it. And with the Woodford Fund, of course, that went bust last year. One of their funds, they were found to have a lot of these illiquid assets. They had investors that wanted to redeem their funds. They wanted their money back, and Woodford couldn't cope with it because they couldn't get out of these private investments or illiquid bonds or equities, whichever that might be. Reading this article yesterday about the trapped Woodford Fund investors who've been waiting for their money since last June. They're going to get some of it. They're going to lose quite a bit of their capital. I started thinking after reading this Wall Street Journal article just about the Fed, what they're going to do today, about the repo, if they're going to wean out the markets off the repo. So here's the article: with rates on hold, Fed faces decision on its balance sheet. Article talks about the fact that they don't want investors thinking that their repo operation or their not QE in T-bills is not to help the market up. They think that the market is getting the wrong impression. It's just a technical thing, right? But what interested me most, and I like going through the comments a lot of times, not only in the Wall Street Journal, but the FT, but I found an interesting one in the Wall Street Journal, and I'll show it to you here. It's from Steven Seeger, a subscriber. And he says, the portfolios of hedge funds, family offices, pension funds are filled with illiquid assets. They also hold stocks, bonds. They also are filled with short-term treasuries, compliments of having been tipped to the new liquidity strategy. They pledge short terms. They get almost free repo money. The repo windows eliminates two issues. This is the interesting part for the hedge funds. The cash meets redemption requests and allows the billionaires to hold the illiquid assets through turmoil. Take away sell pressure, add economic positives, a slug of Wall Street cheerleading, the usual American greed-driven FOMO, you get a melt up. So I thought that was interesting. So basically what this guy said is that the repo market might be indirectly about these illiquid assets, even though these counterparties trading in the repo market are not borrowing money to buy illiquid assets. But what they're finding is that with redemption demands or the danger of redemption demand. And then I thought the Woodford Fund tobacco last year must have put a lot of fear in investors' minds about illiquid assets. And that's maybe what triggered the repo crisis, or one of the factors that triggered it. It could be other things as well. Of course, like the fact that the banks don't have as much as excess reserves. But I'd never seen someone talk about the fact that the trouble in the repo market is because of illiquid assets. So how does the Fed intervening in the repo market and providing liquidity through not QE help the liquid assets. Well, it allows, like Steven Seeger said here, the billionaires, the hedge funds, the family offices, not to have to liquidate at a huge loss their illiquid assets, because we know they're not very easy to turn into cash. So what they do, it helps keep their other assets, more liquid assets, how can I say, elevated, inflated. So if clients want to redeem illiquid assets, they redeem some other assets and give the investors the cash, keeps them happy, keeps the game going. So yeah, I found that very interesting. So yes, I think the Fed and Powell, they're helping these people. We know that Powell, his career started at private equity firms like the Carlyle Group. They're helping the hedge funds, and the BIS came out with a paper saying that the hedge funds are being helped. They're helping the family offices, the billionaires. So yeah, and they're helping keep the whole financial bubble, or the everything bubble, from blowing up. So it's going to be very interesting later on today to see what Jay Powell and the Federal Reserve say about their operations in the repo market and the QE. It looks like they want to start weaning the markets off this. Will they succeed? I'm not too convinced. They tried to normalize rates a couple of years ago, started raising rates, started unwinding the balance sheet, and look what happened. I think they're not going to be able to get out of this. If anything, they're going to have to increase this, because with interest rates negative in many countries, with interest rates going lower, these billionaires, they're going to be clamoring for even more illiquid assets, because they provide better returns sometimes. They're like cheaper to get, and it's something that they think also is undervalued relative to the general public market. But there's a double-edged sword there for these illiquid assets. Very hard to liquidate them. So tell me what you think about this theory. Comment below in the comment section. If you enjoyed the video, make sure you hit the like button. If you haven't subscribed to the channel yet, think about subscribing. Please share the video far and wide. And you can also follow me on Twitter, BitChute, Steemit, DTube, and also Facebook. Actually, I have a Facebook maneco64 page. I wish you all a great day. Take care. Bye.